Welcome to the debut episode of the 5-Minute Investor, where Stockhouse columnists,
I'm Jonathan Brown,
and me, Trevor Abes, each deliver a 2.5-minute stock pick related to a recent news story with investment implications. John, what do you have for us on our inaugural episode?
Well, today I'm going to tell you all about the NASDAQ 100. We had record highs last month, but now we're in near correction territory today. So it was just 2 weeks ago that mega tech stocks and chip makers, they were driving the NASDAQ 100 index to its record highs. And it was 2 weeks ago that it hit its 53rd all-time high since March 2023. It's just 2 years. And that was back when ChatGPT sparked all of these AI dreams. And it's a rally that added 13 trillion US to the index's valuation. And we thought, you and I, investor enthusiasm was going to be endless all the way to the future. However, now it's March 2025 and that tide has turned. The NASDAQ 100 fell 2.5% on Thursday, and it's also down 9% since its February 19th peak. Chip stocks are leading this whole decline. The likes of Philadelphia Semiconductor, that's down 24% from its record back in July. Traders are betting on further drops. Short interest in the VanEck Semiconductor ETF, that's sitting at its highest since December. So I've been following some comments of some experts on the subject. Joe Saluzzi from Thesis Trading, he told Bloomberg today that he sees, quote, significant unwinding of the momentum trade, with high flyers being hit the hardest. The higher you fly, I guess the farther you crash. But the market's uncertainty, that's given fears of trade wars, inflation, the potential recession. It's all shifted investor focus from buying to selling, with tech stocks bearing the brunt of this. And in that same article, Dave Mazza from Roundhill Investments explained that investors are looking at repricing growth prospects based on tariffs and inflation headlines rather than the future AI potential, of which there's still quite a bit. And shares of semiconductor companies used to be the real darlings that we'd be writing about, but now they're under the most pressure. NVIDIA, remember how much we love them? Down almost 9% this past week. And Broadcom, they're down 6.5% this week and experiencing significant declines. But got a good stock to tell you about coming up in a few. But first, I mentioned that speculative tech stocks, they've even been hit harder than all that. The basket of profitless companies down 10% this year. While further pain isn't guaranteed, the current market mood makes a stark shift from this post-election optimism from back in this November, with the S&P 500 losing all of the election gains since then. And I've read a lot of analysis questioning the fundamental outlook for AI-based stocks. That's given that all of these geopolitical factors in the news can just disrupt the scene so easily. And the broader tech sector, and that includes giants like Alphabet, Google's owner, Amazon, Apple, all in correction territory. And the tech sector is down 16% now from its December high. So as for a pick, who's doing all right in all this kerfuffle? Well, let's look at VERS AI. They're a Canadian company. They're on the NEO exchange, aka CBOE, under the ticker VERS. And they've been down lately, it's true, but they are making a comeback roughly to where they were this time last year. They were $1.77 Canadian. Now they're $1.27, but they seem to be marching steadily back up to that point. So we'll see how it goes. We'll see how it shakes out. What do you got, Trevor?
Well, John, my story today pertains to PDAC 2025, the Prospectors and Developers Association of Canada's yearly mining convention, which took place between March 2nd and the 5th at Toronto's Metro Convention Centre. The convention this year brought together over 27,000 mining enthusiasts, myself included, to consider new growth initiatives, investments, and the overall state of the mining industry. I spoke to about a dozen companies across multiple commodities, but I think the lithium miners stood out as the most prospective, especially given that the price of lithium is down by over 90% since 2022, primarily caused by investors overreacting to a slowdown in EV demand, despite lithium batteries' superiority when it comes to competitors like sodium-ion and solid-state batteries. This, in my opinion, is creating what I see as a blood in the streets environment for investors to find stocks trading at deep value prices measured against lithium's multi-generational tailwind. How is this tailwind backed up, you might ask? Well, one source to look at is McKinsey Battery Insights, which sees the lithium-ion battery supply chain posting up to 30% annual growth from 2022 to 2030, when it would be valued at more than $400 billion. Additionally, despite slowing growth, EVs are still taking over global vehicle market share at an astounding rate, expected to have jumped from 14% in 2022 to 20% in 2024. These are green flags to consider an allocation to lithium companies with solid management and high-quality projects whose stocks don't quite reflect their development history. One name that I think is worth your due diligence is E3 Lithium, ticker ETL on the TSX Venture Exchange, whose stock is down by over 50% year over year as of March 6th, despite advancing a 19.5 million ton lithium carbonate equivalent resource spread across Alberta and Saskatchewan. A pre-feasibility study to process the resource into lithium hydroxide monohydrate offers a net present value discounted at 8% of $3.7 billion US dollars. This is miles ahead of E3's $61 million market cap as of March 6th. And this is in addition to the project offering a 50-year mine life, Canada's first lithium in brine proven reserves, and one of the nearest to construction battery quality lithium projects in North America. The company, which has proven that it can produce battery grade lithium products, is on track for commercial production by 2030, when it would become Canada's first lithium in brine producer. Its track record of rational development since listing in 2017 deserves high long-term conviction. There is no good reason for the stock to have been cut in half year over year, given lithium's long-term prospects. Just make sure to keep it in the higher risk, higher return sleeve of your portfolio, given that in the absence of production, E3 remains a pre-revenue company. You can find links to the articles in the show notes. Make sure to check out more investing insights on Stockhouse and the market online. The material provided in this podcast is for information only and should not be treated as investment advice. For full disclaimer information, please visit themarketonline.ca/disclaimer. Thanks for listening. We'll catch you next time.